What is poppin'? It is a Slapton. I'm but a lowly Slapton riding these ReFi waves. And this is This Week in ReFi, where we give you all of the ReFi news that is fit to go ape wild over. With me is the man with the plan, the man still with the summer tan, the perpetual summer tan, the Estonian madman, the 1% just came back from Switzerland, Rez.
Hello, it's me, the 1% that just came back from Switzerland.
Now that you have seen the finer things in life, you see how the other half lives. What can you tell us about the lap of luxury now that you've stayed in a castle in Switzerland?
I don't know. I think I just the view from the castle, which is like 1,000 meters above sea level, and what like has a view directly onto a beautiful lake.
You're flexing on us now. You're just flexing on us.
It's just seared into my memory as one of the most beautiful things I've ever seen. So like it really was. I kind of see why people would like views like that as billionaires. Yes.
So basically, now you've become a greedy capitalist. Is that what you're saying?
No.
To be determined. What? No. The most important question is, when you drink your tea now, does your pinky go up?
It's always gone.
He's always been fine. How dare I? Hey, man, it's the middle of summer, and I heard there's something going on in Paris. Did you hear about this? Some conference.
I have heard some talk about like this conference that is causing a lot of silence. It might be like a silence conference.
A silence conference. I don't like the sound of that.
So like you go to this conference and then no news happens. I think that's the conference. It's the no news conference.
I think you're right.
Yeah.
I think you're absolutely right. But there's this no news conference that is sucking the news out of the ecosystem. But we are bringing the fire today because we always turn up the alpha, the heat, the spice, if you will. Muy picante, and crypto never sleeps, man, and ReFi never sleeps. And what better segue than that to talk about kickstarting your career in ReFi with a curated ReFi job board that is free to join and features high quality curated ReFi jobs. Go do well and good at the same time. Link in the description of this video.
Go get that green money.
Go get that crypto, baby. Let's go get that Verra. Let's go get that Verra news.
Yay, Verra.
Rez, when was the promise for a consultation? When did that happen? How long ago was that?
It feels like it was 3 months ago, but I'm gonna conservatively say 2 months ago. And well, essentially they announced a long time ago that it would happen 2 months ago, and then there was radio silence for 2 months, and now still no consultation.
But the good news is that now we have a timeline for the timeline, and that's something.
Oh yeah, we have a timeline for the timeline.
And that's really what this says, right? Verra plans to launch a public consultation, but we have a date now. In August, so they're saying that they're going to start the process to consult in early August. Now, should we take bets on what that means? Does that mean before the 15th of August, or will that be in December of 2023?
That is a good spread. So like gut feeling tells me it might actually be the 15th of August when they say early August, because that, it lines up. It's pretty nice. It would. I'd be surprised if it was the 1st of August and they would be like, oh, consultation, let's go. You guys are
pumped.
Getting to have your opinion now, finally.
Yeah, so this is what all the ReFi is waiting for. Do you want to? We weighed in on this several times. Do you have a more clear picture? Do you have a gut feeling? Obviously, none of us know anything for certain, so we're all just speculating. But where are you at with Verra and their guidelines and how they're going to approach crypto?
I think what they want to get out of this, what they want to get out of this, at least on paper, should be guidelines of what is normal in terms of KYC when it comes to their collaborators or, tokenizers, if you will. what do these people need to know about the customers bringing supply on chain, bringing it off chain, stuff like that? I think that's going to be a very important question. Second part of that is going to be, should literally everybody that's holding the tokens be KYC'd? And that is something that I think is going to be in the initial proposal of, yes, that should be like the norm. And personally, I think along with everybody else in crypto, I would say that is the most batshit insane thing we've ever heard. And it mostly comes down to the fact that, let's say for the sake of like hypothetical, that yeah, you can KYC everybody on chain. The problem is you can't KYC everything on chain. So in crypto, we have this cool thing that it's not just people that can own stuff. It can also be contracts which are not owned by anyone. They just exist autonomously. They can't be controlled. They can't be modified. They are just there. So the question then would be, wait, do you mean I would need to KYC like a Uniswap liquidity pool contract? Who exactly is the counterparty there? Is that the Uniswap Foundation somewhere? Like, who even is supposed to take legal, claim over that? There's a bunch of interlocking, smart contracts that depend on each other that might be interacting with something. So it's impossible to really do anything about that, and limiting that essentially just completely deletes the value proposition of working in crypto in the first place. So I really don't see how that's going to work out well, and I hope that they will reconsider after hearing reasonable people's opinions on this, but we will see. Finally, what else is going to happen from that is process in terms of databases of how stuff ends up getting tokenized, because they clearly don't like the retirement part of it. Honestly, this could be solved a myriad of ways. The easiest way I would still lobby for is introducing like even as a short fix, introducing like a canceled state. So you can't say you retired it. You have to, it physically shows up in the registry as canceled. Currently, everything just shows up in the registry as retired, even when the reason behind the retirement you put in there clearly says something else. So it's like very annoying. It's just a thing that they designed, I think, a bit poorly, and it's not great.
Yeah, good analysis. I agree wholeheartedly about the KYC part. I think it is reasonable, and I would even argue good to some degree, to know who's bringing these credits on chain. The issuer, I think, is fine. I'm on board with that. I think because there's a lot of malfeasance that could happen with shady things of issuers, and not saying that it has happened, but it probably has happened. And that's just in any system. There are, we have to watch out for bad actors. But sure. I said this to somebody privately about a non-related issue, really about the regulations in coming in Europe with the, their crypto bills. And the minute you start taking away the key fundamentals of crypto, the users of it are going to flee, right? So if you start demanding, let's say, that you need to know my seed phrase for my cold wallet, or which is being bandied about, like, it's just people who, these lawmakers really are clueless about what crypto stands for. They don't understand that this was a reaction to the, the modus operandi, yes, of all of it. Like, if I have to KYC for Verra or for, and like, mandatorily KYC my wallet to hold token, I'm not going to do it. I already have a TradFi system in which this is going to happen. You can make an argument that there's some like layer of it cuts out the middleman. There's more transparency. All that's fine. I am not tying my wallet to my address. It is not happening. And I know there are many like me that feel that way. So I think that's a non-starter. I think any regulation that requires that level of identification is going to fail outright. It can't happen. My belief is that Verra is going to play the crypto game, but they're going to play it in a way that a lot of crypto people aren't going to like, particularly with who can issue these tokens. I don't think it's going to be anybody can do it. I think it's going to be KYC, and probably more centralized than that. So you're going to have to jump through some hoops. It's going to have to be whomever, some legal entity that's recognized in a jurisdiction. And, finally, I think the elephant in the room still is what happens to BCT, which was bridged before, and really in some ways you can make the argument bridged against the advisement of Verra when they put out a missive, I think in October, saying that we don't encourage the tokenization or support. So what happens to that? The more and more I've been thinking and talking to people, it is my belief, and I have no inside knowledge, that they're probably going to leave it up to market participants. That's would be my belief of what ends up happening, where they're going to say, you know what, we're going to leave this up to the market to see what value it has. And in doing so, they're going to absolve themselves of the responsibility of making a determination either way. They're going to, they're not going to say, yes, we support this. They're also not going to be the bad guy and say, we don't support this. But as far as I'm concerned, if that happens, that's going to amount to these things have no value or very limited value. To be seen, but that's where I'm at. And so we still wait for the Verra consultation and some clarity. Man, it's just unbelievable. Like, you get used to a certain pace of development and progress in crypto, and then you start realizing why we have crypto, because TradFi can't get out of its own way, man. How long does
everything? Nothing's moving.
How long does it take to meet with people and say, what do you want? Like, the ReFi community is ready to tell them what we want. Like, we've known what we want. What's the holdup? Yeah.
I also don't understand why possibly could the consultation itself take this long instead of, the response to the consultation maybe taking longer, Like, why do we just have to sit here and say nothing for a while?
Yeah, exactly.
Even though Verra behaved like so, drastically, with no for notice or anything, and then they gave like a notice and then they didn't follow it. Like, the combination of these things just has reduced trust in everybody so much that it's like, Verra, you're really shooting yourself in the foot here. Like, we're trying to help, and this is the opposite.
Well, trust is going to be a theme, I think, of today's episode, because Trust Day. Welcome to Trust Day. Papua New Guinea, man. Papua New Guinea has a lot of forest, and there was a company that wanted to buy up their some of their natural habitat and not tokenize it. Red Plus issues, issue credits under Red Plus, and you have a better handle on this, but it seems like they came to some sort of agreement. I think it was 800,000 hectares.
Yes,
right.
It's a lot. Yeah,
and that has been cut. And give us the rundown, Rez. Why have we cut this?
Okay, so as a background primer to everybody who hasn't heard about Red Plus is a methodology for issuing carbon credits based on protecting existing forests. The idea here generally is that there are forests that are endangered, and you don't want them to get chopped down. So then you open up this new way of generating revenue from forests by saying that, hey, if you don't chop this down, you're going to get a bunch of credits for it. Now, this has historically spurred a lot of companies to buy up very cheap land under these forests, and then essentially do nothing with the forests, ideally, and then they get credits for it, right? That's the whole business model. But what countries have then realized is that, hey, why do these landowners get all of these credits? Why shouldn't we, as the country in which these credits are being issued in order to do nothing with the land, why aren't we getting that revenue so we could do, like, stuff with that money? Because it isn't a labor-intensive job of owning land. Then, going a bit forward, in the last Paris Climate Agreement conference, COP26, governments agreed to this thing called Article 6. Now, Article 6 essentially says that any carbon offsets generated within your country, a government or the country that it's generated in owns these carbon credits unless otherwise stated. So the government has to give you something called a corresponding adjustment, which is that government is going to look at their own carbon accounts. Like you would have something for dollars, but they have it for carbon. And they go like, yep, okay, here's the line that says this forest is generating this much of a reduction in our footprint. And we are going to just remove that from our book. So some other country could have that in their book when they buy your offset, right? Because otherwise, countries can end up double counting. Like, let's say Germany some corporation in Germany buys some RED plus offsets, puts it in their book of like, yep, we're offset. The German government goes like, you see, these guys offset. That's in our footprint now. And meanwhile, in Papua New Guinea, they're going like, yep, never left the country. Everything's fine. That's kind of the accounting problem we had here. So in the conference, they decided that, yep, this is not normal. Government should be able to, do the accounting for who owns the offsets. Now, this is fantastic for countries because they have a great opportunity of generating more revenue from all of these nice RED Plus projects that are happening within their country. And a lot of developing countries have now decided to issue moratoriums, which are, nope, you can't even develop any more RED Plus projects until we have a legal understanding of exactly how much money we can earn off the back of this. Otherwise, we might, walk into a bad deal, and that doesn't work. And it seems that in Papua New Guinea, a project developer was planning on running a huge project, which I think some article said that just the first phase of this 3-phase project would have generated somewhere around 240 million tons of carbon offsets over its lifespan. 240 million. It's a huge amount.
Yeah, it was massive. So I think we quoted 800,000, but they wanted to expand it to 1.2 million hectares or something like that.
Yes. Yeah. Exactly. And they got written permission from Papua New Guinea's government going like, yep, you can develop this project. And then now a few months later, essentially, they have said, nope, we changed our minds. You're not issuing anything. You're not doing anything. You have no rights to issue carbon credits within our country. Please go away. Like, that's not the way we're going to do this. You need to wait just like everyone else. And we're going to put together a framework which is going to tell you how much money we have to get for, allowing you to sell our credits in other countries.
Right. So now we have a legal battle that's going to hit, and this is reported in Carbon Pulse. And yes. I think from the perspective of the countries, it actually is in their best interest probably to put a moratorium on these things because there were predatory deals being done with indigenous peoples or the countries, and they didn't know the value of these. We still don't know the value of these lands because we don't have the infrastructure in the markets, and that's one thing that ReFi is trying to solve. So until we get clarity on what does this land actually generate in value, these countries are saying, no, we're fine just keeping it here. Like, to your point, I had a contractor who used to tell me, like, go to, take these precious metals from the job site. I was like, I don't want them. He's like, they don't eat, do they? Basically, like, what do you care? Put them in a garage, wait for them to go up in value. People scrap metal. It's the same thing with like having a forest, right? It doesn't eat. anything that doesn't eat is easy to care for.
It's like it's gonna keep growing whether or not someone owns it. It's just gonna be there. It's fine.
That's the does it eat test. If it does eat, expensive to maintain. If it doesn't, and that's actually true if you think about it fundamentally, because what is a company? It's a collection of people. Do the people eat? Yes, it's expensive to maintain a company. So that's interesting developments. Where do you think this ends, Sir Rez, legal expert Rez?
Yeah, legal expert, Rez. So not legal advice, but I think RED Plus projects in particular are very in danger when it comes to Article 6 of these corresponding adjustments, because I think a lot of countries are going to realize that, hey, there are a few select rich people who are earning a lot of money by owning land and doing nothing with it. And we need to remove in our carbon accounting constantly stuff that we could have and like potentially meet our own Paris Agreement targets or sell it off to other countries. And then we're looking at it going like, why? Why am I letting this happen? So RED Plus is particularly like a very dangerous category when it comes to this. I think the future of RED Plus is very uncertain. There is a significantly larger than 0% chance that most countries are just going to essentially, not exactly confiscate RED Plus rights, but create fee structures around letting people, take these carbon credits outside of the country in order to, create a revenue stream. But it is also going to make it a lot harder for these landowners to really justify even having a project in the first place.
Yeah, that makes sense. Like, you think of from a country's perspective, why would they, unless they're getting a boatload of money, basically the price of poker is going to go up on these things, right? Unless they're going to get a ton of money, why wouldn't they claim this very low effort carbon credit that will produce, offsets or whatever, credits in perpetuity?
And,
like, why wouldn't they do that?
Yeah, when the only capital costs you had were just buying the land in the first place, the forest was already there.
Why wouldn't you?
From a government perspective, you really need to look at the landowner and go like, what did you do for me?
It's going to come down to bucks, man. So, I think Papua New Guinea will be happy to sell these forests, but it's just not going to be for the prices that we've seen over the last X months or years. It's kind of cool to see that the space is maturing and the value of this is being recognized by nations. I think this is all ultimately a good thing.
Yeah, I mean, ultimately, it'll bring a lot more legitimacy. The whole point of Article 6 in the first place was that the offsets wouldn't, have this double counting risk of two countries and the corporation, double counting everything.
Exactly. Yeah, so we need that. Cool. So you had mentioned very rich people making a lot of money. That leads us to our next story. Adam Neumann's crypto startup delays token launch. Adam Neumann.
Oh my God, that transition.
That was good. That was good, right?
Brilliant.
Adam Neumann made the news. When was this? 2 or 3 months ago? We covered it. Maybe 3 months ago. WeWork founder made a ton of money spinning that up, and now he's into the ReFi space with the Goddess Nature token, right? With Flow, and so they're getting some heat now on the block, and I think it was in the Wall Street Journal that they have not launched their token yet. They've raised a ton of money, had a ton of pre-sales, were the darling of ReFi not too long ago, and now they're getting heat because they're not releasing their token. I have theories on this. You have theories on this. It is probably, I would imagine, something to do with the market conditions. And
they said that it is, yeah.
Yeah, so, I mean, a simple way to put this would be if you had purchased a ton of credits at a certain time 2 months ago or whatever, and now we're where we're at, and things change in the macro economic world, they're worth less than you bought them for. So to launch now and to put these products on the market, you're exposing yourself to a enormous amount of loss. And I would, I would say that I don't know if it's anybody's fault. What do you do if you're in this situation where you basically have overinvested by a lot, right? And now you're in trouble because of things outside of your control. Like, I'm almost thinking you can't launch. Like, it's not ideal, but you depending on what your exposure is, like, it could crush you.
Yeah, I mean, it's a tough time to be Flow Carbon, I think, from that perspective. So they said that they're waiting for the markets to stabilize. I don't know how long that would potentially take, or what they define as stable, because if it has anything to do with like global macro trends, I think they might be waiting for quite a while.
I agree with you.
And, it's not ideal, I think, from the perspective that they still gotta eat,
Yeah, that's right.
They still have to eat for the whole time the protocol's not up. So it's not ideal, I think, for anyone.
Yeah, no, I agree with that, man. It's anybody's guess, right, with the macro conditions. But I mean, there's certainly indicators that we have a long way to go to get to stability. We have rate raises in the European Central Bank, 50 basis points. It was expected to be 25 basis points. America's going to raise rates 75 basis points. We're going to see still what I'd call the great unwinding after a massive inflationary period during COVID, in which central banks were pumping liquidity into the marketplaces.
Stock market, yeah.
Yeah, now they're removing it. Like, how do you get? They're claiming soft landing, but every time these central banks start removing liquidity, there's never a soft landing. So it is an interesting question of what do you do? Do you just take your lumps? Do you launch? I mean, there is a point at which you have to launch, right? Because
there has to be, because otherwise you're just burning so much money, like or what's the term, like spinning wheels in one place, or
spinning your wheels.
How long can you keep like spinning your wheels before you have to drive? So like at some point they'll have to drive.
So there you go, GNT Flow. we're keeping an eye on you now. I mean, I wish them well. I think that
same.
I want their launch to be good. I think that they're good for ReFi, and the attention's good for ReFi, but I hope that works out.
Definitely.
So cool.
Yeah. Let's get some ReFi attention.
Let's get some ReFi attention. So this is, I think, more positive news, Rez. You and I were talking about this. We're very excited about this. I am a Matic maxi. I'll admit this. I think Matic is going to be in just a complete, a behemoth in crypto in general, but they just went live with their ZK EVM. How you feeling about that, Rez?
I love it. I just I think everybody was waiting for Polygon to come out with their like next generation of layer 2, but seeing it finally on testnet now, I believe, that's super cool. So I'm excited. I mean, at the end of the day, when it comes to layer 2s, Polygon, or these side chains or anything that's built on Ethereum security, Polygon has been doing great results for a very long time, and I think the user experience is just going to get a lot better if we have even better tech on Ethereum. That's so cool.
Yeah, so the implications too would be that we have the ability to make Ethereum even more environmentally friendly. These ZK rollups, zero knowledge rollups, are going to batch transactions, and they're going to be able to withhold certain amount of information, which helps with privacy. And because it's EVM, my understanding is that anything that is programmable for Ethereum now immediately becomes programmable for the Polygon.
That's actually been true for quite a long time.
But with this tech in particular too, like it's still the same thing, right? So you can still run, still run your EVM and be good with it. So yeah, the scaling looks good. Polygon is notoriously at this point, its proof of stake its footprint is minuscule. I forgot the number. It's like.
It's nothing.
It's nothing. Yeah, I mean, you and I probably produce more carbon dioxide. Yeah, we probably do. So very cool. Very interested to see what happens with that. And then we have the merge happening, the proof of stake merge with Ethereum. But after that merge, Sir Rez, we have the Surge.
The Surge.
Coming from Vitalik himself. Merge, Surge, Verge, Purge, and Splurge. So the merge is from proof of work to proof of stake. That's slotted for September. Again, that should really decrease the carbon footprint of the Ethereum blockchain.
If you guys want to hear more about the merge, we went quite deep into the merge last week. Not gonna rehash this in too much detail this week.
That's right.
Go and give us more go and give us more views. Please also like and subscribe and leave a comment down below going like, wow, I really like the merge. Thank you.
There you go. All right, so what is the Surge? If we have the merge in September, what will the Surge be?
The Surge is going to be this interesting thing of, do you know how many transactions Ethereum is capable of doing per second right now?
20.
I think it's somewhere between 20 and 30. So it's very low, and people are competing a lot for these few transactions. That's why gas prices are very high, because you have like a lot of people willing to pay increasingly larger amounts in order to be first. That's the system essentially. We're auctioning off these transactions all the time. But we're going from 20 to 30 to theoretically 100,000.
Ooh, doggy, that's a big jump. How are we going to do that?
That is huge. So it's going to involve some very intense math and sharding. But at the end of the day, it's just better parallel processing of getting stuff into the transaction tables. And that is going to allow us to scale a lot harder. And what does that mean? That means gas prices are going to go down by a lot. A lot. If this happens, like, other chains are in trouble, because Ethereum has been doing really well, even under the conditions of potentially having one of the least performant blockchains out there when it comes to just like the competitive landscape. It's been the most expensive to do transactions. Transactions aren't particularly fast. These are all like big downsides, but even then, Ethereum is considered to be like top tier in terms of just having the most value on it, having the most builders on it. And if transactions are going to become also very cheap, very fast, we are all going to be very happy, and it's going to put Ethereum into a position of just, even on pure technical details, outcompeting a bunch of other chains.
I think I agree with everything you said. I'm a bunch of maxis. I'm a BTC maxi. I'm a Ethereum maxi, Matic maxi. You can figure that out. I don't know. I'm maxi all three of them. I think it's really silly whenever I hear Ethereum killer. It's not going to happen. It's never happened. There's too much of a market effect. There's too much trust. It's been through too much. It wins in every security discussion you want to have. And if it can accomplish this sharding, it's game over, and it's not even close. There will be no reason really to use any other smart contract layer. I shouldn't say, I mean, there's always gonna be niches, right? Like Solana, I think it's gonna have its NFTs, but institutions and just most of DeFi will be on Ethereum, which it already is. I think 60% of TVL is on Ethereum right now.
Yeah, it's somewhere in that ballpark.
Yeah, right? It's insane, man. I think people lose sight of how far ahead of Ethereum is from everybody else. Like, it's not even close. So, and with the sharding, like, I think my conception of this, and it's beyond my pay grade to think about the coding, is if you have 100 nodes right now, 100 nodes have to verify all of the chain, all of the blockchain currently, and that's not efficient. So if you could take sharding, you could basically take the chain, break it up into 10 pieces, and then you take 100 nodes and break them up into 10 nodes each, 10 blocks, then you can have each one focusing on a part of the chain, which makes things a lot more efficient and a lot less bottlenecky. I think
it's very non-bottlenecky.
Very non-bottlenecky. So I look forward to that. I mean, obviously it's a long way off, but the fact that we're going to see the merge and then hopefully the surge, bullish, bro.
Bullish as fuck.
Hey, are you bullish? Are you bullish on Elon Musk selling 75%, I should say Tesla, of its Bitcoin holdings recently? Are you bullish on that?
I don't care.
You don't care. I don't care either. I agree. Dude, this is getting so much attention, and I'm just like, who cares? People were saying Bitcoin's going to dump. Like, who cares? Like, that Tesla dumped 75% of its Bitcoin hold. Like, what's the implication here? That because they dumped 75%, Bitcoin's over? Like, Tesla is the one who determines if Bitcoin's, like, the right bet. And then, like, the other assumption is that Tesla dumped it because they don't believe in Bitcoin. Tesla dumped it because they wanted to show good earnings. This was a pure cash play.
They got some good old fiat on their books. It's good.
Yeah, and they just released their earnings, and their earnings per share shot up because guess what? They just sold a bunch of Bitcoin. Like,
it's like, we're Tesla, we're an investing company, you know. That's the vibe.
Yeah, it's incredible, man. But the amount of attention this is getting, this is like CNBC's picking this up. Like, who cares? I've always said I don't care what any one person or entity thinks about Bitcoin. I care what the world thinks about Bitcoin. Tesla can say Bitcoin is the worst thing in the world. Warren Buffett already has. I don't care.
Yeah. I do love the snarky comments CNBC left at the bottom of the thing, which was linking Elon Musk's tweet saying Tesla has diamond hands. Yeah. And then replying to it in one sentence saying a lot can change in 1 year.
Right. Yeah. Well. Who do I dislike more?
Diamond hands fell off. I don't know what happened.
Who do I dislike more, Tesla or CNBC? It's a tough one. I think it's CNBC.
The snark. It's truly snarky.
All right, so that's a nothing burger as far as I'm concerned. But I don't think this one is. This is the SEC lists 9 crypto tokens as security following Coinbase insider trading charges. SEC is the Securities and Exchange Commission. They are a regulatory body of the American regulatory framework, and their job is to regulate securities. And the problem is, what the heck is a security? Well, that's up for debate in the cryptosphere. There's a couple tests, the Howey test. There's a couple. It's just basically like case law at this point, or precedent, that determines what a security is. And I'm not going to go over it. Everybody's probably heard it 1,000 times, but we don't know in the crypto world what a security is. The SEC is not giving any framework. They're kind of picking and choosing what is. They've gone after Ripple as an example. That's like famously in court right now and has been forever. The only thing we do know is that Bitcoin at current is not considered a security by the SEC. It's considered a commodity. And the reason you don't want to be a security is because they are regulated much more draconianly than commodities. A commodity is something like oil. There isn't like a body that puts onerous restrictions on the trade of oil, but there is on a security. So that's the long and short of it. 9 of these coins, I mean, they're random. AMP, XYO, Power Bro. I haven't even heard of half of these. DDX, RLY, they're now considered.
I started Googling them and going like, oh, I guess that's a thing. I don't care. Like,
yeah, I don't care about them either. But the implication of this goes further than those coins, because what says you about what this means for crypto, and if the SEC is going to doggedly go after these small coins? Like, what does that mean for our space?
I'm really sad,
Yeah.
That's about the review on that, because I think something that maybe regulators keep forgetting is the way you get to be sufficiently decentralized is time, generally, with a lot of these, because over time, your ownership will be more decentralized, the way things operate will be more decentralized. The goal at the end of the day is to have something that is finished and, everybody can move on because there's now code existing on the blockchain that's going to work perfectly forever. But it takes a while to get there. And there's obviously like some human processes here and there for a lot of projects for quite a long time. So how do I feel about this? I feel kind of annoyed more than anything. And as a second thing that I would like to raise here, insider trading is a fucked up thing in crypto. Like, I think we don't really appreciate just how much insider trading happens in crypto and how fucked up that is, both ethically, like morally and legally. If you run a project, you shouldn't be trading your own token like as a day trader. That's fucked up. Please, for the love of God, don't do that. Even if you never get caught, it's just a shitty thing to do.
How do you feel about contributors? This is like, this is also kind of a thing I've thought about, is if you're a contributor in a protocol, when stuff's going to happen, right? Before it happens, and you could trade against that news before anybody else. And
we discussed that at Solid World. We're gonna ban insider trading. Like, we're going to fire and sue you if you do it. Like, it's not cool.
I agree with you. I think it is immoral, and it's like, it shouldn't. I don't think all regulations are bad. I think that's a good regulation. Don't let people insider trade.
But how do you enforce that without, the law is very,
It's very difficult, yeah.
Yeah, exactly, because it would put it does put the pressure on the, organization itself to moderate itself, but that doesn't necessarily happen everywhere, and you can't force that to happen without, doing like weird draconian shit. So like, I accept that in some areas here it's like very gray, and there should be a lot more transparency.
Yeah, and you're never going to cut it out entirely. Like, as an example, I don't know if you know who Nancy Pelosi is, but she's like a big deal in the American government. So she's got this husband, right, who's like this billionaire, and it turns out that he just invested like hundreds of millions of dollars, a lot of money. I don't know the exact number.
Yeah, happens to be one of the best traders in America for some reason.
Well, this just happened. He just invested a ton of money into like chip makers in America right before a Senate bill passed that was going to give $5 billion to develop chip manufacturings in America. It's like
weird.
Strange, right? So it's not just crypto, but it is out of control. I agree with you. It needs to be brought under wraps. And so our favorite inside traders to talk about, of course, is Celsius. The accusations are that they were screwing around with their token with Depositors funds. They filed Chapter 11 bankruptcy, which basically means that they have a chance to restructure using a trust. So it's going to be a long, drawn-out process. But at the same time, it does give depositors some hope that they have some say in the process. But this was an interesting headline. Celsius network lawyers argue that users have no rights to their crypto. Of course, this is that old adage, not your keys, not your crypto, which is technically true. What do you think? Do you think in this case that it's as simple as not your keys, not your crypto? I have my opinions. I don't think so.
I think all centralized crypto things don't have a right to exist.
I think you're right. It's like it's a complete contradiction of like values, right? Like
yeah, it is. It's like, hey, we made all of these decentralized things that are like transparent by design, and you get to know where your stuff is, how it's used, who owns it at the moment. Like, this is just information that's out there. And then instead of that, going like, oh, and then we're going to build a platform on top of that, so we could get to borrow a bunch of money to Free Arrow Capital, so they could buy dick butt NFTs with your money.
That was a good investment, okay?
Yeah. So if you want to know more about that, we also talked about that last episode.
Dick butts are the future, okay?
Dick butts are the future. Bullish on dick butts.
Nah, I agree, man. Well, here, like, obviously I don't know what's going to happen, but my clap back when people just use that like very unnuanced, not your keys, not your crypto, which I think has merit. Like, you shouldn't just give your keys away willy-nilly. A centralized entity can't just then take your crypto and do illegal things with it, right? Like, that's not how it works, because there was an agreement saying that you're going to give relinquished control to Celsius, but you expected Celsius to do these things. Well, if
you expected them to loan it out, reasonably with like expectations of return,
right, not pump its own coin and then pump and dump its own coin. So, if you find out that there was legitimate fraud happening, then that contract is not binding anymore. So it'll be a cluster to see what happens with Celsius.
Really?
Yeah, man. And I'm very excited. And I have money riding on this one, so that's always fun to know how much I'm not going to get back. But at this point, I think what's going to happen is they're probably going to give, at the end of the day, like Mt. Gox just started their dispersals or whatever, or they're going to, I think, pretty soon after years of I think it's going to be a similar thing, and you're going to get back a percentage over an absurd amount of time.
Yeah.
Probably. That's usually how these work out. And the next protocol I want to talk about, or we want to talk about, is I think in a very similar place. And this is Bancor. And this was a protocol that I will admit I was shilling at one point, made a video about, was very excited about. And it was OG, man. It was the first AMM as far as I know. In DeFi.
Yeah, one of the first AMMs, like in a long time ago, like 2017, 18, somewhere in that area.
Yeah, this one hurt.
They've been around for a long time.
This one hurt because I expected it from Celsius, but I don't expect it from a DeFi, a smart contract protocols, particularly one that had the history and the trust built into it for Bancor. But basically what happened is Bancor got really carried away with itself, and it had something called impermanent loss protection. And the idea was that when you LP, that they could offset your losses, your impermanent loss, by paying out in native BNT token. And this was done in a way under version 2.1 that was a little bit more conservative. They had a 100-day lockup period, or a 100-day permanent loss protection period. So every day you got 1%, and that allowed them to build up a surplus of fees. So when you eventually withdrew, that they could pay you out. And it also happened during a period where there wasn't as much market volatility. We saw insane market volatility recently. So they migrated to V3, and they basically said anybody can put any amount of any coin that they could into this Omni pool, and they would promise everybody impermanent loss protection paid out by BNT. Now, this is the part that really pisses me off, Rez. We agree that one of the things about DeFi that can be good is smart contracts because they can't be changed, but these were changed. So there was an emergency powers were invoked, and it was decided because BNT's price was crashing that you would not be getting impermanent loss protection. So now Depositors are looking at like 45 to 50, maybe more % deficit if they're going to withdraw. It's really troubling. I think it's been covered before that, who do you trust what is the value of a smart contract if a protocol can at the end of the day just say, hey, we just changed your smart contract, or the terms in which, that you're playing with? It's like
it's complicated because on the other hand, if they didn't do this, I could guarantee to you that most people would be leaving with not 50% losses, just like 0.
Yeah, it would have tanked.
Yeah.
And it would have been race to be first out.
Yeah, exactly. It tanked, but you're still in this situation of most people would get 0. Like currently, everybody, even if you're left right now, would still get something. If no one pressed that button, you'd be fucked. It's just like, buy. Yikes.
Right. And that's the argument for it. So I got out. I'll admit, I took a haircut. I took a 45% haircut on my assets, which wasn't crazy. But there are people in there who have a ton of money and they just can't come to like lose half of their stack, like their entire life savings. So now they've come up with these, this is what we're going to talk about. They come up with a bunch of plans to get their money back, right? And this includes, fee allocations, basically capturing fees from swaps and offsetting impermanent loss protection. That's a lot of it. They were talking about arbing their own pools, being the arbitrage of their own pools and capturing that values before outside arbitrageurs do that. And I would say if you could just undo 50% deficits, if you could essentially double your money with just a few easy steps, pardon my French, Rez, why the fuck didn't you do that in the first place, right? All of a sudden, you've got this magic way to make money and fees. Well, it seems maybe like wishful thinking. What are your thoughts on that?
Okay, so I think let's have a tokenomics lesson, everybody.
Yes.
I have a few notes, so like let's do tokenomics. So I was very wrong about this protocol. I'd like to say, like, I
Same.
called it very wrong.
I agree.
I have learned, and I would like to impart what I have learned so I could be less wrong next time. So let's talk about this interesting thing we could call, I heard somebody using this term, so I will steal it, endogenous value tokenomics.
I like that.
So what does this mean? Endogenous means, contained within, on the inside. And the point is, if you're these are protocols where the value of your token plays some sort of role in your protocol's ability to function. So, like in the most catastrophic example, endogenous value tokenomics was Terra and Luna, because Terra's ability to stay backed depended on Luna's value not tanking heavily. Because as long as people are willing to buy Luna, Terra is like very fine. If people all want to run out the door with Luna, Terra's value is not okay at all. That is what endogenous value tokenomics essentially is. So to anybody ever doing analysis on a project that looks to be in this shape, I have a very neat checklist for you of if that protocol at some point will just go to zero or not. So like, here's the checklist. If you can follow this checklist, either you can be on a side of like a very valuable trade, you will make a lot of money and you will be happy, or you will be the user of the protocol and you will hate yourself for it.
Basically, you will either get wrecked or be the wrecker.
Yes. So if you want to be the wrecker, also here is the same checklist. This is going to help you make like an insane trade at some point, not financial advice, obviously. Like, don't do this because I told you to do it. Do it because you are yourself convinced based on all of your research that this was a good idea. Anyway, question number 1. Does the price of your own token play a role in your protocol's ability to operate? This is true for Bancor. It's just true because every time somebody takes a loss, they have to sell BNT. So BNT has to have value, because if its value was 0, they wouldn't be able to print more BNT to cover your loss, right? Because we're selling into the market. Everybody that holds BNT is worse off because of it. Because of this event. Obviously the protocol can do other things around it that create value for BNT, but that specific one event loses value for people holding BNT. Second question. Does your protocol have a function, has a function that can rapidly increase its own supply? So if we have BNT, for example, and somebody has like a really huge loss, is this going to create a correspondingly huge amount of BNT, like suddenly entering the market? Because surprise, 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 if you increase the supply too fast, it can also have really bad effects because everybody, loses a lot of value at the same time. These sorts of market shocks generally eat through order books. If you're on a centralized exchange, it's just gonna fill all of the buy orders on its way down. There's gonna be no one buying at the bottom. It's all just going to be maybe on-chain liquidity, but that's all you're going to get. So it's a nasty situation to be in. It's not good. If a protocol can rapidly, without the community's collective agreement, increase the supply by a lot, it's necessarily going to happen at some point, and it will be very painful.
And that was true for Bancor. They were printing crazy amounts to cover their crazy impermanent loss, which was leading to more impermanent loss.
Actually, the main point for them actually was the fact that they had Celsius and Free Arrow Capital farming their liquidity pools. And this wasn't even because of them covering impermanent loss. This was them using their impermanent loss insurance token as just a reward. They gave out loan obligations as a reward to people for being just, LPs in their system. But what this meant was the moment Celsius and Free Arrow Capital and these guys needed to get out, on their way out the door, they wrecked your protocol because they sold all of your token. So now your price is low, so your ability to cover impermanent loss is bad, but also all of your trading pairs are connected with Bancor, so you have a lot of impermanent loss.
It created impermanent loss, yeah.
Yes, it created impermanent loss, exactly. Okay, third point, very important. Is it possible to anticipate this rapid supply growth we mentioned in step 2? So in step 2, we had, rapid supply growth. Is it possible? Step 3, we have, can you give a specific timestamp for when this is going to happen? Because if step 1 and 2 are true, but, you just have this kind of, shock going through the market and it's done, it's over, nobody even noticed. There's not a lot of recourse for that. So it won't cause a spiral necessarily if you don't anticipate it to happen again immediately, right? So, it's like, oh, I got wrecked. But on the other hand, I can see that this won't happen like immediately again to me. So like my position isn't to sell out because I expect like this to happen to me again and again and again, right? So this is very important. Can you time it? Can you predict that it's going to happen? Can you predict that it's going to happen at a specific moment? You can do this with Bancor, and you could do this with Luna because both of them, there was essentially just you're on a clock. Like, that this supply is going to come online. It's going to dump every single market. With Bancor, this was because when they upgraded to version 2.1 into version 3, they had this nifty thing that before you could take out liquidity at any moment, and they would, cover your impermanent loss in that moment. It's done, done. In version 3, you have a 7-day unlock period. So it takes 7 days before they will cover your impermanent loss. But then you take it out, and, it happens. But when everybody saw that Bancor's price went down a lot, they immediately were like, oh, I need to run out the door. I need to be the first person out of the door. So everybody could already anticipate that in 7 days, there's going to be a huge amount of BNT essentially created and then sold into the market immediately, right? So there's a timeline. You now know essentially what direction your token is going to go in, down. And when it's going to go in, do that. 7 days. The combination of those things is a trade. This specific trade is called a short. So this is when you sell off you borrow someone else's token and sell that off into the market because you think it's going to be cheaper to buy it back to give it back to them at some point in the future, right? That's what shorting is. So the last question in Rez's 4-step checklist is, are there liquid markets where you can short your token? Because if the answer to that is also yes, and people can do huge shorts, they can take like huge positions where they just sell off a bunch of your token before your protocol can sell off a bunch of your token, your tokenomics is fucked. It's going to collapse in on itself like, a badly built house. It's just going to crumble. There is no other outcome that these 4 steps can have. Your protocol will die from this. Yeah. So if you're ever doing due diligence on a protocol and it seems to have these 4 steps, tread with caution. It's probably fucked.
Yeah, I agree with you. I mean, basically, what you're describing is protocols like Bancor gave opportunity and warning for bad actors to take advantage of their bad tokenomics. And in retrospect, I don't know how I didn't see it, probably because, I don't know, I just didn't want to see it. The Bancor tokenomics are insanely flawed. I didn't spend enough time with them. I didn't dig into them. But when you look back on it, it's just like, why would anybody do this?
Yeah, exactly. And it's, for me, the rest of it kind of checks out. Up until the point where you give out people free loan obligations. I think this tokenomics has some merit if the supply of your token is constantly deflationary and only has a very few like inflationary moments. But in general, the supply of your token, everybody expects it to go down, and they can't predict when it's going to go up slightly or, this kind of thing. Because if there's already a built-in expectation that the supply is going to increase rapidly, that's a trade. Like, if you can expect the loss in value, you are going to trade the loss in value, right? So the loss in value is going to be more because people anticipated it. That's how markets work. You do a trade, you know that there's going to be someone else selling a lot, so you sell before they do, and you make a lot of money on it. So that market dynamics can ruin endogenous value tokenomics very easily.
Very. And one more thing I'll add to this, this is my opinion, is we've kind of been chasing, a lot of DeFi protocols are chasing how to offset impermanent loss for LPs. I don't think it's possible. I think you're just going to have to accept that with the current constant product market makers that we have, that it is an inherent risk. And anybody who tells you that they can avoid it is lying. You might be able to avoid it in a bull market or a sideways market, but when we get this crazy volatility in the downside, it just wrecks. It just wrecks. And so, like, you know, what was happening was Bancor was able to offset some of its losses by selling off its native token through swap fees and things like that. But that doesn't keep up when the market tanks 70% like it does in crypto. They're not making that kind of bank. And that's the end. That's the end of the ball game. Yeah,
exactly. Impermanent loss protection is a very expensive form of insurance. I personally do believe you can cover impermanent loss, but it would need to be based on extracting all of the fees almost on like whoever actually is taking the impermanent loss risk. You as the token holder probably wouldn't be making almost any fees.
That's what I mean. Yeah, I mean, it's this classic DeFi pretending that it can solve like a fundamental problem. Like, you can't do it. You can't create value by printing your native token. You can't do it sustainably. So where's the value coming from? It's coming from fees, but the fees can't keep up with the volatility in the market. And that's exactly what we saw. It's, you know, you and I were talking beforehand that like, we got into crypto because, or I should say some of us got into crypto. I think crypto took off because people were tired of the money printer and they were tired of the fact that you had fiat that was uncapped and it was controlled by a centralized authority and it was trying to spend its way out of debt. And we're seeing that time and time again with these protocols. Like, when will we learn, right? When will we learn? We were supposed to be better than this. That's a dour ending to our show. Say something. Yes. Say something funny, Rez. Save the mood. That's it.
Go outside, touch grass. It's fine.
Go outside, touch grass. It's fine.
All pain is temporary. You will be fine.
That's true.
Exactly. All pain is temporary. If you lost money, learn from it. At the end of the day, that's the only thing you should be taking away from any losses. How do you avoid that same loss next time?
That's right.
So here, it just comes down to understand more tokenomics. Get wrecked a few more times. You will learn eventually, but up until then, just, you know, at least try to have fun with it. And please, for the love of God, do not invest more than you are willing to lose. This is when people make the worst decisions ever.
Agreed. Rez, what are you bench pressing these days?
Still the same as last week, sadly.
Well,
I haven't even gone to the gym since we last talked because I've been traveling and doing gym stuff doesn't really go well together, sadly.
There's something to be said for consistency. I'm going to ask you I'm going to hold you accountable. Actually, okay. All right, man. We'll catch you all on the next one. Remember to ape responsibly. Peace, dudes and dudettes.